Welcome, everybody, to our Long Verticals and Diagonals webcast. I'm Connie Hill, Senior Manager and Education Coach. Glad to see that you joined me here today. You know, in the past, we've been focusing a lot on diagonals and spending kind of a lot of time because they are a little bit more time-intensive type trades. Today, we're going to focus a little bit more on long verticals, and I'm going to tell you I have a trade for every size of pocketbook. Meaning if you're somebody that's just starting out, don't have a lot of funds, we've got a smaller type trade, a medium type trade, and a big old grandiose type trade for those of you with really deep pockets. I am joined in the chat by Barb Armstrong. So glad Barb's here, fellow friend and great coach that she is. She's here to help me field some questions I can't quite get to. So as you have those, go ahead, chat them in. I'll be keeping my eye on it. Barb will as well. And we want you to get your questions answered. Now, if you're listening to this on the recording, and I know lots of you do, when you have questions, go ahead and put them in the comments section in YouTube, because we go back, we review those throughout the day, make sure you get your questions answered here as well. Now, I do hope you're following us on X. Barb posts a lot of really good, fun information. She's Barb Armstrong, CS. I'm Connie Hill, CS. So follow us, it's free, it's easy to do, and you pick up a few tidbits along the way during your trading day. Let's go through our disclosures and get down to business. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes only. Don't consider it a recommendation. We will be using the Paper Money software application. This is what you download to your computer. It's the most robust version of Thinkorswim. Has a lot of nice tools for option traders, which we are in this webcast, definitely option traders. Past performance of any security or strategy does not guarantee future results or success. All right, our agenda for the day, we're going to have a quick announcement. We are going to talk a little bit about, some principles of long verticals and diagonals, maybe how they differ and how they're similar. We're always throughout going to talk about the impact of price, time, and volatility as it relates to options and the development of those option trades. We're going to be looking at a lot of examples here today, so take plenty of notes. Take screenshots, whatever it is that you need to keep on track. And I should say, I'm happy to see so many familiar names out here in the chat. Want to welcome each and every one of you. And if you didn't chat in, you're obviously welcome to be here as well. First announcements, upcoming workshop and market drive events. If you can get to any of these or you live close to them, man, take advantage of them, all right? San Diego, June 5th and 6th. Chicago, July 17th and 18th. Dallas, when it's nice and hot in August, Dallas is a great place to be for that market drive event. Barb will be at some of these events. She attends many of them. And so it's a great opportunity for you to mix with coaches, get to know them. Always introduce yourself. They love, I shouldn't say there's they, because when I'm there, I love it too. I love for you to come up and say hello. It's fun to be able to put a face with your names that we see here in the chat. All right. Verticals and diagonals are the only strategies that we focus on in this class. And it's kind of nice because then we can just really hone in on those two strategies. Now, they're similar to each other in that we're always buying a long leg and selling a short leg. Usually, what's going to be involved is a net debit, is what is created from this. A diagonal, well, I should say a vertical, we're using the same expirations. Whether they're weeklies, whether they're monthlies, it doesn't matter. It's going to be using the very same expiration date with verticals or with diagonals. And this creates a little bit of a twist on things. We are using different expiration dates. And usually the expiration date for our long leg, we have it go out longer in time. And the short leg is usually shorter in time, shorter in duration. And so we end up selling against that longer dated long leg, well, theoretically and hopefully many times. We sell against it, bring in premium, sell against it, bring in premium. And we try to do that over a long period of time. And so some of our past trades, we've really seen go on for several months at a time. Last week, we started some new ones, so we're going to keep managing those particular trades. Let's see. Let's see. Barb says she will be at the Dallas Market Drive event. Excellent. All right, let's head over to Thinkorswim. Make sure we get it here in the right spot. All right. What's going on with the markets today? Yesterday was a nice big bullish day, big bullish candle that you can see here. The 10 is a 10-period exponential moving average. So very much what is the short-term trend doing? The red is a 30-period moving average, so more intermediate. And you can see lately how the SPX has stayed pretty much most of the time above that 10-period moving average. It's pulling back a little bit today, which is probably not so unheard of since we had a little bit of a pullback yesterday. That's what things are looking like on the SPX. We trade a lot of stocks on the NASDAQ, so let's maybe take a peek at what the NASDAQ is doing. You're going to say, oh, is that the same chart? Because they look so similar to each other. And so it's pulling back a little bit here today as well, but you can see how nicely it's been trending above that 10-period moving average. That might lead us to think maybe the strategies that we're going to work with are going to be a little bit more on the bullish side than the bearish side, just because if a market's going up, the majority of the participants are going up as well. And so we don't want to fight. We don't want to fight the trend. We don't want to fight that stream. All right, let's take a look at this. I told you we're going to focus on long verticals today, which we are. We're going to be doing long call verticals. And I said I have something for everybody's pocketbook, right? Meaning your account size. First stock we're going to take a look at is Cipher Digital. Now, this particular stock is only a $20 stock. So it hasn't been on my radar for a really long time because usually most of the stocks I'm looking at are a little bit more higher priced. This particular stock has caught some attention lately because it's made some really big moves recently. You can see here, it was down here about below 1172. And even from that low, that was on March 31st. So just say about, 6 weeks ago? And where it went up here to this high at almost $23, that was an increase of about 96%. So this is really, I'm going to say, a volatile stock because percentage-wise, it's just moving big numbers here recently. Then from its pullback here, so let's go to, say, this bottom here. Oh, we can't see it. Let me scrunch this a little bit better. That pullback was about 23% over a period of 9 trading days. Okay, so even though it's a smaller dollar stock, it is fairly volatile, and there's a big movement expected because it has been moving so much. Now, as we come over here to the trade tab, I want you to notice today already it's traded over 9 million shares. And so it has some weekly options. It has a lot of trading activity, which makes it very nice for us. Now, if you wanted to, you could poke around in the weeklies and see if there's something here, maybe like, say, 22 days to expiration. Many times when working with long verticals, using 20 to 40 days seems to be an ideal window. So we have some June 20, expiration June 18 that has 28 days to go. So we should be seeing quite a bit of liquidity here. Now, this is my open interest column on the call side and the put side. And you can see a lot of them have some really good, nice numbers of contracts. And then there's some of them that are newer. Say this 20.5 strike price here. It hasn't been around as long as the 20. So these increments of $1, you can see they are the ones that really have the majority of the open interest. But when something starts trading in frequent time frames, and sometimes what will happen is they will introduce additional strike prices, assuming there has been a lot of activity going on with the, say, the single strike increments, okay? But for our purposes, we're always looking to be where the fish are, right? We're wanting to be where the contracts are. Makes our trading a lot easier. Let's take, for example, the June 20, which we're going to use as our long leg if it still looks like it's going to work out for us. 265 by 277. That's less than 10 cents on the spread. That's nice and tight. We love to see that as option traders. The tighter it is, the easier it is for us. So on this setup, let's see if this still makes sense. Things may have moved a little bit. As we look at the chart here, oops, that was a little too squishy. One thing I was noticing here, this is a little doji candle, a little reversal type candle, and it did indeed reverse yesterday. However, today it's got some nice follow through here, up 6%. RSI is in a real strong position. And so for some traders, they might look at this as a nice little bullish entry. The other thing I would see on this particular stock is maybe that it's in a triangle type pattern. And so I'm gonna kind of maybe use the bodies, maybe a little bit more on the bottom there. Maybe kind of go up here a little bit. And ideally, this stock should break out in the direction of the preceding trend, okay? Well, the preceding trend's been more bullish, so we would expect this to break to the upside, but technically it could break to the downside, okay? It's an ascending, or it's a triangle that is kind of similar on both ends, right? Versus an ascending triangle that has a flat top and higher lows, or a descending that has a flat bottom and lower highs. These are a little bit higher lows, a little bit lower highs, creating that symmetrical triangle. Now, question along in here says, how do I pick these stocks? Prakesh wants to know. There are different methods that I use. One method, for some of them that we're going to look at today, come from a watch list that we may have created in this class. I can't remember which class it was that we did this in, but I think it was this class here. We did a watch list called Liquid Options, and this one is dated the 7th of May, I think. Liquid Options 5/7. So we ran a scan for it. The details of the scan, basically, we're looking for liquidity, looking for a lot of trading activity in the price of the stock, and I think I have the minimum there is like 2.5 million, trying to look for some really good liquidity. Another place that I get some of our trades that we look at in class comes from a different scan. That scan is called, I'll go to it now, I've already got it open, my Early Morning Movers Bullish Scan. And it is looking for basically stocks of at least 10 bucks that are up to day 2.5, sometimes I should say 2.5%. Sometimes I have that at 1.5%. When we got a lot of bullish activity, I raise that up to 2.5%. And then I just kind of look and see what stocks are coming back on that. Sometimes I'll sort it on the volume. So like today's volume, which ones are having some of the biggest moves here today? Looking at that. Sometimes we'll sort that by percentage gain. Okay, so both of those methods are really frequently where I get these stocks from. Today's CIFR came from this Early Morning Mover Scan. Okay, sometimes I'll just kind of take a look at it, see who happens to be moving right now, see if the chart looks like it has an entry. All right, let's go back to our trade tab here. For this long vertical, we definitely need the stock to move. Now we could, if we wanted, we could go stocks at $20.80. So technically 21 is our at the money strike price. And many times we'll start with at the money. If you wanted to, you could do this. You could do a buy vertical And rather than taking the strike price at the 50-cent increment, spread it out so that we're working with lots of open interest here. Change this to 22. There we go. And so in this scenario, say you have a smaller account and you're like, yeah, I can only risk $100 a trade. Something like this might be suited to some of you because you would be risking now $39 and say you could only risk $100 a trade. You could even do 2 contracts here, right? So you would be risking $39 to make what? $61. Okay, so that kind of movement means the stock absolutely has to move 20, what was that, 21 even, right? No, 22. So 21's our long leg, 22. It would need to get out of this triangle to get up to 22. So we definitely need some movement there. Now, if you wanted to be a little bit more efficient with your contracts and you wanted to spread it out a little bit so you weren't paying as many commissions on a spread, which is sometimes why people will do this, what we could do, and I don't know if these numbers are still going to make sense or not, but what if we were to take it to 20 to 22? Then you wouldn't have to have quite as many contracts. We are risking a little bit more to make a little bit less, meaning we would spend $87 to make what? Well, 100 minus 87, and that would be, in the neighborhood of $100, and let's go $113. So risking 87 to make 113. Still is a really decent, if we were to get that kind of a return over 100% that we might be looking for, okay? So depending on what kind of an account you have, these could be some options with this trade. For our purposes today, we're going to go with this really small one. We're going to go the 21-22 strike. Oh, yeah, somebody would like me to share the scans. I will share the scans with you. Actually, the one scan, I think I saved it. We'll have to go take a peek at it. But let's go ahead. In this account, we can risk up to $2,000 per trade. Now, in a trade like that, that means we would have a boatload of contracts. Let's go bring our calculator up here. If we did want to risk $2,000, and we would divide that by $44 because that's our risk on the trade, we could do 45 contracts. Now, not everybody's going to be comfortable doing 45 contracts, okay? In our case today, we're just going to go 20. We're going to go 20 contracts here. So we would stake a smaller position. And again, you adjust this, the contracts, the size of your risk that you have tolerance for in your account. So that's where we're going to start here. Typically, we'll say if we can get a chunk of the gain here, if we can get a chunk of profit, we're going to take it and close the trade out early. We're not going to try to milk it for everything that it has, okay? So we're going to go first trigger sequential, create an opposite order here. And what would you say? Okay, let me get our calculator back here. What is our theoretical max gain? Well, let's go 1 minus 0.42, which means 58 cents because we went down to the $1 wide spread. So $58, let's multiply that by the 100. So we're going $58. What percentage of that would you be pleased with enough to say, let's take it and move on? Okay, you're all going to have a different amount. And it might vary per trade. A lot of times in this class, we'll do 70%. Today, the magic number is going to be 50%. When we get 50% of our max gain, we're going to be happy campers, say adios. Okay, so we'll divide that by 2, which means we're going to be looking for a gain of $29. Let's add that to our $42. That says when it gets up to 71 cents, we're happy to cash out. We'll take our profit. We'll get out of the trade. Now, many times people don't set stops on a trade like this because it's already kind of a hedged position, right? We've got a long leg and a short leg there. So sometimes people don't like to do that. If you did want to do it, however, some people might use 50% as a place where they'd say, this trade is just not going my way. We're going to get out. Okay, so just giving you some ideas there. We are interested in making this one a good till cancel. And let's go ahead, let's push it on in and let's go on our way. Let's send this to our dynamic diagonals and long verticals bucket where we keep track of our class trades. All right, we got filled on that. Looking good, I think. Let me just check that real quick. All right, yeah. Got filled at 38 cents on that. All right. Got in a little bit cheaper than even what we thought we were going to get in at. All right. Now, a couple questions here, which are great. Yerrick says, by choosing a higher strike price to sell, does that mean it becomes a point where profit stops to raise at expiration? Or am I confused? By choosing a higher strike price, which we did on the long leg for a minute, and then we switched it back to the $1 increment of strike prices. What it does for you really just means that it sets up the vertical in a way where you probably don't have to buy as many contracts. And now in these kind of contracts, we're working with 2 legs, so you would have 2 commissions, right? 65 cents per leg. And so the logic there is, well, if I don't have to spend as much commission, 65 cents, if I can reduce that maybe by half, right? Because I said we could do 44 contracts. We're doing 20 contracts here. But it just makes the trade a little bit more efficient. But some people might not want to do it. Okay. Our end target, we still need it in both of those. We still would need it to go to $22. The stock's a mover. Not too concerned about it getting to $22, right? Because we've seen those huge percentage moves in a small period of time. And so that's the advantage of some people, why they might choose to do that, is looking at it from a, I don't know, a thrifty standpoint. Maybe I'll say it that way, okay? Where you're not buying as many contracts, you're still getting a decent move out of the stock, you still have expectations of movement, just using that higher strike price if you wanted to. So hopefully that makes sense on that one. Profit is capped, but you don't want to go in the money. Now, Mike, I want to kind of clarify something there. We actually do want these to move into the money. They are long verticals. We need to close them out. They're not like a short vertical where you can sell and maybe not have to go close it out. These ones we definitely do, and we want it running into the money. That's how it's going to become profitable for us, okay? Now, there is a survey out in the chat, and we do this from time to time. I don't control it, nor does Barb. Other powers that be control these surveys, but we do solicit your feedback. We want to make these sessions good for you, and so we love to hear your thoughts. These are easy surveys, and I can be a fan of easy surveys. All right, 2 questions. You just fill in the radio button, plop, plop, on a scale of 1 to 10, what your thoughts are. Then if you would like to answer a question, because one of them says, hey, what would you like to see covered in this webcast? Feel free to share your thoughts there. Or if you want to communicate something else to me, please do so there. It's a great opportunity for you to be able to say, hey, I don't get this concept, or I'm struggling with this problem as I'm paper trading and practicing. Could you help me out there? Use that space for that. Okay, we love that. Barb will repost it again throughout our class here today, but I'll try to remind you at the end as well. If you want, click on the link now, let it sit in the background, and then before you have to take off, go ahead and fill that out. All right. Let's see. Yarek is saying, I understand at 22, the higher strike price we sold becomes horizontal in the Analyze tab. We could go look at the Analyze tab here. Let's look at, let's look at this trade. Excellent. That popped it in there for us. And let's go make sure our date is good. So we've got June 19th, which is right. Let's come down here and say set slices to our break-even price on June 19th. And so we end up with a risk profile here. Some of you might not be as familiar with this. This teal line represents our profit and loss at expiration. So our max loss is down here. It cannot be any more than what we paid for the stock here, or rather the options here. So it's showing us down here 760 as our max theoretical loss. Our max theoretical gain is up here where this flat line is. All right. And these are trades where your risk is known, where your potential reward is known before you even get into the trade. And this one, we kind of are able to skew it a little bit, looking for an aggressive move to have maybe a little bit more profitable profit in the trade. Okay. Although we have put in, we're going to be happy at 50% of whatever that max potential gain would be. Let's see here. All right, I think we're good. Let's carry on. Yeah. Next up, we're going to do another long vertical, but we're going to move through it a little bit more quickly here. This one is for the medium pocket people, meaning you have a little bit bigger account to work with because our strike prices are going to be bigger and our net debit is going to likewise be bigger. Okay. Bloom Energy. These guys look like they could be having a breakout today. Now, it won't be confirmed until the market closes, but I'd kind of have my horizontal resistance there about 303, 304. Looks like it's busting through there today. Looks like we're going to have some really good volume. It's almost up to its average volume, and we're still really early in the trading day. So that theoretically could be something that some people like to get in on a breakout entry. Let's head over here to the trade tab. Let's look at BE, and it's traded over 8 million shares a day. Similar thing here, it has some weeklies. We're going to focus on the June 18s of 28 days. It's in our sweet spot of time that's helpful to work with. Some traders really like it. And we're going to do a long call vertical. And we want to kind of see where are a lot of these contracts. And the ones that are not as liquid, we would just avoid. 4 contracts, 2 contracts, 42 contracts, we just aren't interested. Okay, so pay attention to that. I'm a big stickler for open interest. We could here, the stock is at 317. Ooh, so it's just almost in between, isn't it? We're going to go with, on this one, I was initially looking to go 300, 310, but the stock has moved up quite a bit. So we're going to have to shift that here. Let's look at 310 by 320. So we'll say buy vertical. And our 320 has lots of open interest here. So again, we're going to spread it out a little bit. Make this 320. Again, if you didn't want to, you don't have to. You could do the 315. I just don't like that low of contracts. 91's not bad if you're just doing, say, 1 contract. We're going to do more than 1 contract in our account. All right. In this case, we'd risk 438 to gain what? What is that going to be? 562? Okay. That's what we're looking at as far as our risk and reward. Again, we can risk $2,000 in this account. Let's bring this back up. So $2,000 divided by 438, we can do 4 contracts. Strike prices are bigger. We're still, even if you had, say, you could risk only $500 in an account, You could still possibly do this trade. So that's why I'm saying it's a little bit more for maybe those that have the ability to be able to risk more in their account. They're not trying to just only get, say, risk $100 or $200 a trade. We can do 4 contracts, so we're going to, get it back down here. This time we are going to put on that stop loss we talked about. This time we're going to do a first triggers OCO. One cancels other. So if it hits our target first, great. It cancels the stop loss. If it hits our stop loss first, darn. We're happy to, minimize our loss though. So we're going to create 2 opposite orders here. One we're going to put as the target, the other one we're going to put as our stop loss. Now bringing back our calculator, if we take, I'm going to lock this in. It's moving around. It's 4:45 right now. Let me go ahead and just lock that in. So we're going to say $10 minus 445. Where did the $10 come from? That's our strike difference. Okay. Says, okay, then what we have to gain is 555 on this trade. Well, if we can gain 555, awesome. But today we're going to go with the 50%. If we can have 50% of the 555, we're going to be happy campers. Move on. Okay, so let's multiply that by 0.5. So 277 is what we're going to add to 445. We're going to say, all right, if we can get out at 722, that'll be our 50%. We'll be happy campers. We'll be on our way. Now, what about that stop loss? I said sometimes people might set it at 50%. Maybe some of you would set it at 30% or 40%. Generally, by the time he gets to 50%, many people are like, this trade just doesn't look like it's going to go my way. And so they may consider getting out early because of that. All right, so 445 divided that by 2 is 222. So if our spread gets down to 222, that would be our stop area, trigger a market order, right? Get us out of the trade. And then, of course, we want both of these to be good till canceled. So our target at 722, our stop loss at 222. All right. Let me just check, make sure we don't have any questions on this particular one. I think we're doing good here. Let's set it up. Let's send it to our dynamic diagonals on long verticals. All right. Now I do actually have a couple more trades I would like to get to. However, we're going to take a break and look at our existing trades and talk through them, see what needs to be done. All right, so we're going to do a little management here. So let's come here. Good thing we got filled. And we need to come down to, kind of just scroll this down, Apple. Apple is a long vertical that we have going on here. Let me just do something real quick. We've got Apple. Whoa, look at our Apple trade going on here. Look at this. We're up 85% on this trade. We've got a working order out here on Apple. It's triggering to say, hey, get out at 823. Well, what if we could get out early and go ahead and just take that gain? Would that be worthwhile? Some of you are going to say, absolutely, let's go change that order, take our profits. Some of you might want to hold out for longer. I try to be flexible here. If we get a good chunk of whatever we had here that we said we'd be happy with, and we know it can always change real quick, yeah, we might just want to kind of take a look at that. So on Apple, let's just see what the chart is doing here today. It's moving nicely, moving higher for us. Could it get better? Yeah, it probably could get better, right? However, we're going to take the stance of saying, let's lock in a sure thing, okay? So let's take it. We're going to say cancel replace order. We're going to flood in the current price. We're going to try to get that midterm price and see if we can't get out of that trade and be done. Take our profits, move on, find a new trade, which we already found 2 others already. All right, how about Microsoft and Walmart? These are both diagonal trades, and some of them are going to be going on for a long while. Let's talk about this Walmart trade. Yeah, NVO says 85%. Why would we stick around for that? All right. Walmart. Last week, we put on a trade that's going to go on for a long time. And I say a long time because we bought out to the March 2027 option. So a couple of you are interested in maybe having a LEAPS contract in our portfolio that we could continue to sell calls against. So we have this longer dated option, 130 call. We sold the 135 call, and now we brought in 221 here, and now it's down to a penny. Did we get most of that gain? We absolutely got a majority chunk here. Now, the other thing we need to notice here is that our longer dated option, it actually went down significantly. Based on what these 2 contracts did, what do we know about Walmart? What direction has it gone in the last week? Think it's gone up, or do you think it's gone down? Well, Walmart actually was up until today because they announced their earnings. They have a gap down here. And interestingly enough here, I have not looked at the report. Maybe some of you did, and you know why they dropped so far, because they just announced that this morning. Now, as we look at this, does it meet your criteria for exiting a trade, a long trade? Now, there might be some of you that say, well, it's down below the 10 now, it's down below the 30. It is almost back down to here, where its most recent significant low was. But I would say it's kind of gone through the point here where we could have called this a low, and maybe even some horizontal support here. So there may be some of you that say, oops, stay there, that it broke support significantly enough that you'd want to be out. If that was the case, go ahead, get out. Because I want to work this for a long period of time, because that was the intent of our trade, as long as it stays above this point here, we're going to continue to sell calls against it and see if we can't recover some of the money that we've lost by virtue of that option going down so low. Okay, so what are we going to do? Again, I wouldn't fault anybody that wanted to exit the trade. But what we're going to do is we're going to go ahead and sell some more premium. We're going to see what we can get back. 121 is slightly out of the money here, 122 a little bit more. We're going to go for the next week, and what we're hoping by this time next week is that we've got a majority of that, and then we roll it again. Okay, try to roll, roll, roll. If this thing, however, closes significantly below this low point, and I might just put a little note in here that we're going to have our mental stop kind of right in that area. I'm going to say mental stop 117, just so we kind of have an idea there. That's where it's going to be. So let's roll our leg and let's go out. I'm going to go to the 40-something delta. If you wanted to be more conservative, you could go out a little further out of the money. If you want to be more aggressive, you could sell out the money or slightly in the money. So here, let's go ahead. Let's do the 121 that's at a 41 delta. So go back here. We're going to say, we've got 3 contracts here. We're going to say create rolling order, which just allows us to do both of them at the same time. If it's confusing to you to roll, and you're like, oh, I'm just not comfortable doing that, go ahead, close out the leg, go buy back those short legs, and then just go and sell the ones that we're going to do here. So here's our 135. And so it just puts the next week out, which is just fine, but we're going to change this to 121. All right, that's going to be that. Let's look at that. So 121 right now is about 190-ish. Okay. So we're bringing in most of that credit because the other leg is just not going to cost us that much. We're going to hit confirm and send that in. The other one we need to check out is Microsoft. Now, Microsoft position, it's a diagonal as well. And we on it are not as far dated out. This is just a July option. So on this particular trade, again, our short leg just has one more day, so we want to roll. We don't have as much of it. We don't have 90% of it like we did on the other, but we'll take it, right? That is what, $1.60 something? Sure, we'll take that. We're going to roll it. What are we going to roll it to? Let's go to the Microsoft. Let's go to the option chain. Oops. And here, let's go out to the 29. Well, if we wanted to be real aggressive, we could sell for next Monday, or actually Tuesday, because Monday's a holiday, Tuesday, Wednesday, or Friday. We've got several options here. I really want to go for, I'm going to go for the 27th, because let's see, that'll be, no, let's do the 29th. We want to do the 29th. That'll be Friday. So we'll have some time with this one. Again, I'm going to go out to a 40-ish delta. That's going to give us 422. 50 strike price is the one that we want to use there. So we go back to our trade. Where did he go? Let's go back here. Let's just do create our rolling order again. And we're going to change this to 422.50. There we go. Close down the 420. Bringing in a little bit of a credit. Good. We're going to send it there. We're going to put it in our diagonals bucket. And see if that got filled. Now, the other order didn't fill yet. After we're finished here, I'll go back, see if we need to make an adjustment in order to get that Walmart to fill. All right. Looking to see, all right, I think we're good on the questions here. Thank you for helping me out here, Barb. All right, our time is almost up, so I've got a couple things I need to cover with you. One, if you're not a subscriber yet to our Trader Talk channels, what are you waiting for? Are you waiting for a personal invitation from Barb and I? Well, if you are waiting for that invitation, here it comes, all right? When you subscribe to our Trader Talks channel, you just click on that little logo, bottom right-hand corner, that says subscribe, and it looks like YouTube. Then it makes it a lot easier to find our content. What's going on? So after our class today, investing in dividend stocks is going to be up next. Brent Moore's going to lead that discussion. And then you can see throughout the rest of the day what is going on. You can see our playlist for our different class. You want to go back and check something? Great. You can go back and do it, finding our playlist. Okay, so I'm just going to encourage you to do that. We did have a survey opportunity here today, so I'm going to encourage you to do the survey opportunity. And if this is helpful to you today, hit the like button. That lets others know that you found this information useful and might be doing a favor to somebody else. Now, don't have a ton of time on this one, but I am going to show you what the setup looks like here. This is for somebody maybe even has a bigger pocketbook. And I say bigger because it's a $700 stock. It's Micron. It's bouncing up here pretty nicely off that 10-day moving average. Earlier today, it was looking like it might be our hold. We won't know until the day is actually over if it really is going to close there. But it certainly has traded above the high of the low day. So some traders like to use that as an entry as well. On Micron rather, looking to do a long call vertical. We're going to use the June 18s. I'm just going to throw this in real quick. We'll follow up on it in our next class. And we're going to do probably, oh, we're going to have to adjust here. I'll show you what it is next week. We're probably going to have to adjust. It's moved a little further. We might have to do something like 745 to 750 or 750 to 760. That's probably what we're going to end up doing, 750 to 760. All right. Appreciate you being here today, you guys. I think you should practice trade any of these trades that we've looked at today if you're trying to get a handle on long call verticals, trying to get more comfortable with it. Okay, that's the way we get better, is by practice, practice, practice. All right. We are in for a 15-minute break, and then at the top of the hour, Brent Morse will be there with investing in dividend stocks. Barb, appreciate your help today. Again, go ahead, fill out that survey. I'll read every single thing that you write. We'll see you next week. Bye-bye.